Everyone is doing well. Today I'm going to discuss the LBO model. We use such models usually in two cases. First, from a valuation perspective, when a private equity fund wants to understand what is the valuation for the target company that would enable it to reach its target IRR, and we also use it from a leverage finance perspective in order to understand whether the cash flows of the target company would support the financing structure put in place. So as always, we start with the assumptions block. Here we would need to take a view or an assumption regarding the financing debt. It is usually expressed as a multiple of EBITDA depending on the company and the profile, the cash flow profile of the company and the industry, whether there is volatility or not, etc. So here I assume that such target company can assume a financing of 5 times EBITDA. This is usually spread across senior debt and junior debt. Also, you would need to have assumptions regarding the interest rates of senior debt and junior debt, the maturity of the debts, and most importantly, the entry and exit multiples. Entry multiple is the multiple at which the financial sponsor would acquire the company, and the exit multiple is the multiple at which you would sell the company at the end of the investment horizon. The last assumption you would need to take is the annual increase of performance of EBITDA margin. And that's it, you're set up to run your model. So the second block is the P&L, so it's a fairly standard P&L with sales, EBITDA, EBIT. And the only thing which is new here is the financial expenses. If the LBO is well set from a tax perspective, in most jurisdictions, if the conditions are reached, you can deduce the financial expenses of the LBO debt from the P&L of the target company, which would result in debt tax shields. So this is the first lever of value creation in an LBO. This is the fact that you can, if it is well set, of course, if it respects the tax rules, you could deduce the financial expenses of the LBO debt and generate debt tax shields. Then the next block is about the features of the financing. So as discussed earlier, you generally have senior debt. Senior debt is a bank debt. Usually it is composed of two components, a term loan A and term loan B. Such components differ in the maturity and their interest rates. For example, you would have a term loan A of 7 years, term loan B of 8 years, and the difference in terms of interest rate. So here, for the sake of simplification, I assume that there is only a term loan A amortized over 8 years. In terms of quantum, in the assumptions, we say that the senior debt is 3 times EBITDA, and the junior debt is 2 times EBITDA. So the junior debt is also called subordinated debt. It is subordinated because its payments cannot happen until the payment of the senior debt is done. So senior debt is paid first and then the junior debt. That's why junior debt usually yields a higher interest rate. The junior debt can take several forms. Here I assume that it takes the form of a high yield bond, bullet, over 9 years. Bullet means that only interest payments occur until maturity, and at maturity the principal is fully paid, so there is no repayment of principal until maturity. Also, what you could have is a mezzanine financing, also called equity kickers. I don't use it here for the sake of simplicity, but it's good to know, since in most LBO models you can come across such kind of financing. So mezzanine is a financial instrument which is at midway between equity and debt. For instance, a convertible bond. Investors in a convertible bond would get interest payments until maturity, and also they would have the option to convert their bonds into equity, and as such have a share in the payments at the exit. They could have access to equity and thus sell the equity along with the shareholders and get a share of the final payments at the exit. Other useful definitions that you could come across in LBO models are the cash sweep. I don't use it here, but when a cash sweep is set up, it means that the cash flows generated by the target are used to repay the debt. Whatever cash flow is generated in a given year, it would go to debt repayments if the cash sweep is set up. Also, another notion that is interesting to know is debt sculpting. Debt sculpting depends on certain ratios. For instance, the leverage ratio, the DSCR, and the interest coverage that we will discuss shortly. The concept is that we should allocate part of the cash flow generated by the company to repay the debt in order to reach a given or a target ratio level. If, for instance, I want to reach a DSCR level of 2 times, I would allocate part of the cash flow generated by the target to reimburse the debt in order to reach a DSCR of 2 times. Just modeling calibration in order to reach a certain constraint. Also, another definition you could come across is a vendor loan. As the name says, this is the loan provided by the vendor in order to pay the vendor 100% of the purchase price. You would, for instance, pay just 80% now and 20% later. So it's a loan granted by the vendor in order to help finance the deal. So those are the main definitions. What you would have also here are debt schedules. For instance, for the senior debt, you would have $105 million at the beginning of the period. We said that such debt would be amortized over 8 years. So each year it's 105 divided by 8, which gives $13 million per year. And thus, at the end of the period, it's just the amount that you had at the beginning of the period minus the principal that has been repaid. The last line is the interest. So it's the quantum of the debt at the beginning of the period multiplied by the interest rate. So on and so forth. So you do this for every year, and you see that at maturity in year 8 and in year 8, you would have 0 senior debt at the end of the period, and the interest paid would mechanically decrease over the years. So for the junior debt, we said that it's a bullet, so only the interests are paid and no principal is repaid. So you would end up in the year 8 with $70 million since the maturity is 9 years. If we added 1 year, the debt would have been fully repaid in year 9, but since we stop at year 8, we exit at year 8, you would have a stock of $70 million. Also, what you will usually see in LBO models are debt ratios, such as the leverage ratio, the interest coverage ratio, and the DSCR. So the definition slightly differs from one bank to another, based on the definition each bank has regarding the risks and the ratios. But usually the objective of such metrics is to understand whether the cash flows or the profitability of the target is enough to repay interests or to repay the service of the debt being the principal plus interest. So really this is the objective, to see whether the company is profitable enough or whether it generates enough cash flow to repay the interest and the principal. So the most widely used ratios are the leverage ratio, usually defined as net debt to EBITDA, interest coverage, which is EBIT by interest paid, and the DSCR, which is EBITDA divided by principal plus interest. So again, the definitions might slightly differ, but you get the idea. The other block is the cash flow summary. Here we look at the free cash flows before financing. So it's standard definition of free cash flows generated by the target, EBITDA minus tax, change in working cap and capex, and see whether those cash flows before financing are enough to cover the debt repayment and the interest paid of both the senior and the junior debt. So in this example, we see that they are enough. Since I have a surplus, cash flow remaining to equity holders is positive. And the shareholders of the target can have two options: whether they will leave such cash flow remain within the company, or they will distribute it to the holdco as dividends. So the fifth block is the IRR calculation. It is a summary of the cash inflows and cash outflows for the private equity fund. So the first item is the equity amount cash outflowed by the private equity fund in order to acquire the company. So in order to fund the purchase price, it has two sources of funds. First one is the LBO acquisition financing, and the second source of financing for the company is the equity, which is put by the financial sponsor on the table in order to acquire the shares. So here I assume that the target has no financial debt, so the EV would equal the equity purchase price. I assume that entry multiple is 8 times EBITDA, from which I subtract the financing which is issued, which is coming from the LBO debt, this one here, both senior and junior debt. And this is how we calculate the equity put on the table by the financial sponsor. So this is the first layer. Then the second cash stream is the dividend received by the holdco. This is equal to the cash flow to equity generated by the target company. And the last stream of cash flows is, of course, the sale price of the proceeds of the sale minus debt from the sale of the target company. So we assume that it is sold at an exit multiple. We multiply it by EBITDA, and we subtract the debt that still remains in the target co in order to get the equity value that that would go to the private equity fund. So here I subtract the junior debt, since it is not fully repaid yet, and which leads to the proceeds to the financial sponsor at the end of the investment horizon. If we sum up all those cash flow streams, we get to the total cash flow stream for the private equity sponsor, and those streams would enable us to calculate the equity IRR. So it's fairly simple. You just use the IRR formula, which includes all those cash inflows and cash outflows, and we see that for the example that I have chosen here, the IRR is 25%. So usually private equity sponsors target 20-25%. In the good times, in the bad times, they may target a little bit less. The other concept which is interesting to check is the money multiple. So it is a very basic concept. It is the multiple or the ratio between what the financial sponsor has put at the beginning when it had purchased the company, and the financial proceeds that it gets when it sells the company. So here we see that the financial sponsor would make 4 times the money it has injected when it purchased the company. So that's it. So as a conclusion, just wanted to remind you that we use such models from a financial valuation perspective in order to define which acquisition price would enable the financial sponsor to reach the target IRR, and also from a leverage finance perspective in order to check whether the target company generates enough cash flow to support the financing structure. So in terms of value creation drivers, first you have the performance improvement. You see here I took an assumption of 1%. If I say that the private equity fund manages to improve the EBITDA margin, let's say 2% per year, so you see that we improve the IRR from 25 to 29. So I set it back to 1%. And let's check the second value creation driver is multiple expansion. Here we assume that there is no multiple expansion. We buy at 8, we sell at 8. Let's say that we buy at 8 times EBITDA and we manage to sell it at 11 times EBITDA. So you see here that it moves to 31% from 25%. Sell it back at 8. The other lever is the financing quantum. The higher the leverage you could put, the higher the IRR. So let's put it at 6 times. And you see again that it improves. And the last value creation driver is the one that we discussed first, is the fact that you could deduce the financial expenses from the P&L of the target company and thus generates debt tax shields. Of course, this is possible only if the tax rules of the country in which the holdco is set up are respected. So that's it, a really quick overview of how an LBO model works. If you have any questions, just drop me an email. Bye-bye.